This video will review Chapter 3, Accrual Accounting and Income. Our learning objectives for this chapter: number 1, explain how accrual accounting differs from cash basis accounting. Number 2, apply the revenue and expense recognition principles. Number 3, adjust the accounts. Number 4, construct the financial statements. Number 5, close the books. Number 6, analyze and evaluate a company's debt-paying ability. Number 1, explain how accrual accounting differs from cash basis accounting. On your screen, you'll see that you have two columns. On the left side, you have accrual accounting, and on the right side, you have cash basis accounting. Comparing the two of them gives us a reference point to really kind of understand one versus the other. Let's first review the cash basis accounting. Cash basis accounting records only cash transactions, cash receipts, and cash payments. So the idea is that if you have revenue, it's only going to be recorded when you actually receive the money. The cash comes in, you have revenue. And in terms of expenses, you only have an expense if you pay it. You write a check out, you take the expense. That's what cash basis accounting is. Now, the downside to cash basis accounting, the next bullet point says you ignore important information. And we're going to see how that works. The third bullet says results in an incomplete financial statement. The fourth bullet says we only use cash basis accounting for the smallest businesses. And so, in fact, many small sole proprietorships and even smaller partnerships and corporations use the cash basis of accounting to report for tax purposes, because that gives them some element of control in terms of their income, and then that will dictate how much they pay in taxes. So cash basis accounting is something that does happen for smaller organizations and for those organizations that use cash basis accounting for tax purposes. Now, just so that we understand accrual basis of accounting, there are 3 bullet points here, records impact of transactions when they occur. In other words, we're not so focused just on cash, we're focusing on when an economic event actually happens. Accrual accounting is required by U.S. Generally Accepted Accounting Principles, GAAP. So since we're learning financial accounting, since that's what this course is about, then we have to learn accrual basis of accounting. And the reason being is because GAAP requires accrual basis. And so the last bullet says it records revenue when earned and expenses when incurred. In fact, that's going to be a basic principle that we'll review in the future. Okay, so now discuss cash basis of accounting because we needed a reference point. You need a starting point. Where do I start off? Well, it's easier sometimes for us to see that cash basis makes sense because we look at it in the context of buying and selling, and we record transactions when cash comes in and when cash goes out. So we learned about cash basis just more for a reference point because that's not what we use in financial accounting. Accrual accounting records cash transactions such as collecting cash from customers, receiving cash from interest earned, paying salaries, rent, and other expenses, borrowing money, paying off loans, and issuing stock. It's not like we ignore cash transactions for accrual basis of accounting. We do record transactions when they occur. But in addition to that, when we look at accrual basis of accounting, we also record non-cash transactions, such as if we have a sale and we sell it on account, then we record it. We're expecting to get paid and we record it. When we purchase purchases of inventory on account, we're going to record that as well. Accrual of expenses incurred but not yet paid. Depreciation expense. Usage of prepaid rent, insurance, and supplies. earning of revenue when cash is collected in advance. Accrual accounting also puts in play the time period concept. And the time period concept means that accounting information is reported at regular intervals. The time period concept involves basic accounting period is 1 year. So the basic accounting year is 1 year. Around 60% of large companies use the calendar year from January 1st through December 31st. A fiscal year may end on a date other than December 31st. What we're going to learn is that some companies actually have a fiscal year and that's different than December 31st. And when we say fiscal year, it's really a full year, but it starts and ends on different days rather than January 1st and December 31st. And companies also prepare financial statements for interim periods. So when we say interim periods, we're talking about portions of the year. So we're going to come up with an annual financial statement. There's no question about that. But companies also report income and expenses on a quarterly basis. And when we say quarterly, that's every 3 months. And they also report financial statements on a monthly basis. But usually the monthly basis is for management only, so that they can see where things are going by month to month. When we're talking about external users, for the most part, external users are more interested in quarterly financial statements and annual financial statements.